Hey, welcome back. If you have ever looked at a financial report and had absolutely no idea what you were looking at, this video is for you. Today I am walking you through the entire world of accounting, from the very first transaction all the way through to finished financial statements. We are going to follow one simple business through all 8 steps of what is called the accounting cycle. And by the end, everything, journal entries, ledgers, trial balances, financial statements, all of it is going to make sense. Let's start at the beginning. So what exactly is financial accounting? Financial accounting is the process of recording, summarizing, and reporting a company's financial transactions. The goal is to produce financial statements, documents that give a clear, accurate picture of a business's financial health, which can then be shared with investors, banks, and tax authorities. Think of it this way. A business does hundreds of transactions every single day. Money comes in. Money goes out. Bills get paid. Sales get made. Loans get taken. Financial accounting is the system that captures all of that activity, organizes it, and turns it into reports that actually mean something. And the way it works follows a specific 8-step process called the accounting cycle. To make it real, I am going to use one fictional company throughout this entire video, Bright Ideas Limited, a small consulting business. We are following their first month in business. Step 1. Identify transactions. Step 1 is the starting point, and it is simpler than it sounds. Before you can record anything, you need to decide which events actually qualify as accounting transactions. A transaction is any event that has a financial impact on the business. Something that changes the value of what the company owns, owes, or is worth. Paying rent, that is a transaction. A customer paying you, transaction. Buying equipment, transaction. Taking out a loan, transaction. What is not a transaction? Signing a contract by itself is not a transaction, because nothing of value has actually changed hands yet. Having a meeting is not a transaction. For Bright Ideas Limited, 6 things happened this month. 6 transactions. We are going to follow every single one of them through all 8 steps. Step 2. Prepare journal entries. What is a journal entry? Once you have identified your transactions, it is time to record them. And the way you do that in accounting is through journal entries. A journal entry is a formal record of a financial transaction. Every transaction gets its own entry, what happened, when it happened, and which accounts were affected. Think of the journal as a financial diary. Every day you write down what happened. Later you organize those entries. But the diary comes first. What does a journal entry look like? Every journal entry has 4 things: the date, the accounts involved, the amounts, and a short description. And every entry has 2 sides, a left side, which we call a debit, and a right side, which we call a credit. The most important rule in all of accounting is this: every journal entry must have equal debits and credits. Always. No exceptions. Here is what the first journal entry looks like for Bright Ideas Limited, the owner investing $10,000. Cash is debited, meaning cash increased. And owner's equity is credited, meaning the owner's stake in the business increased. Both sides move. Always balanced. What is double entry accounting? What I just described is the foundation of the entire accounting system, double entry accounting. Double entry accounting means every single financial transaction affects at least two accounts. Always. No exceptions. When you receive cash, two things happen simultaneously: your cash goes up, and something else changes too, whether that is revenue, a liability, or equity. This system was invented in the 1400s and has been the global standard ever since, because it creates a built-in error check. If your books do not balance, you know immediately that something went wrong. Now, here is where most beginners get tripped up. Debit does not simply mean increase, and credit does not simply mean decrease. The effect depends on which type of account you are dealing with. So for assets and expenses, debits increase them. For liabilities, equity, and revenue, credits increase them. Keep this on screen as a reference. It will make the journal entries much easier to follow. What is the accounting equation? Double entry accounting is built on one foundational equation. It is called the accounting equation, and it is the most important equation in finance. Assets equal liabilities plus equity. Everything a business owns, its assets, was funded by either borrowing money, which creates liabilities, or by the owners putting money in, which creates equity. Assets are things the business owns or controls that have economic value. Cash, equipment, inventory, property. Liabilities are things the business owes to others. Bank loans, unpaid bills, taxes owed. Equity is what is left over after you subtract all the liabilities from all the assets. It is the owner's share of the business. Every single transaction keeps this equation in perfect balance. When you borrow $5,000 from a bank, cash goes up $5,000 and your bank loan goes up $5,000. Both sides of the equation move by exactly the same amount. Let me show you all 6 journal entries for Bright Ideas Limited. Watch how every single one stays balanced. Every entry, debits on the left, credits on the right, perfectly balanced. That is double entry accounting in action. Step 3. Post to the general ledger. What is the general ledger? Now that all our transactions are recorded in the journal, it is time to organize them. This is where the general ledger comes in. If the journal is a financial diary, entries written in the order they happened, then the general ledger is the organized filing system. It takes all those journal entries and sorts them by account. Every account gets its own section in the ledger. Cash has a page. Revenue has a page. Wages has a page. And you can look at any account at any time and see every transaction that affected it, plus the running balance. The process of moving information from the journal to the ledger is called posting. What is an account? Before we go further, what exactly is an account? An account is simply a record of all the increases and decreases in one specific item. Think of it like a bucket. Every time something goes in, you record it. Every time something comes out, you record that too. And at any point, you can look at the bucket and know the current balance. Cash is an account. Wages expense is an account. Bank loan is an account. Every line you see on a financial statement is, at its heart, an account. The 6 types of account. Every account in accounting falls into one of 6 categories. First, assets, what the business owns. Cash, equipment, property, amounts owed to you by customers. Second, liabilities, what the business owes to others. Bank loans, unpaid supplier bills, taxes owed. Third, equity, the owner's stake in the business. The money they invested, plus profits that have been kept in the business. Fourth, revenue, income earned from business activities. Consulting fees, sales, service income. Fifth, expenses, the costs of running the business. Wages, rent, utilities, marketing. And sixth, dividends, money paid out to owners or shareholders. The first three, assets, liabilities, and equity, are permanent accounts. They carry their balances forward indefinitely. The last three, revenue, expenses, and dividends, are temporary. They get reset to zero at the end of every accounting period. We will come back to that in step 8. What are T accounts? The most common visual tool for tracking account balances is called a T account, named because it literally looks like the letter T. The account name sits at the top. Debits go on the left side. Credits go on the right side. The balance is the difference between the two. Let me trace the cash account for Bright Ideas Limited through all 6 journal entries so you can see exactly how this works. Cash has a debit balance of $15,800. That is exactly how much cash Bright Ideas Limited has in the bank right now. You do this for every account, and together they form the complete general ledger. What does the general ledger look like? The general ledger is simply a collection of all these T accounts, one for every account the business uses. In modern accounting software it is a digital database, but the underlying logic is identical to the physical ledger books accountants used for centuries. Once all journal entries have been posted to the ledger, every account has an up-to-date balance. And now we are ready for step 4. Step 4, Unadjusted Trial Balance. What is a trial balance? Step 4 is to prepare what is called a trial balance. A trial balance is a list of every account in the general ledger alongside its current balance, either a debit balance or a credit balance. It is basically a summary of the entire ledger on a single page. Its main purpose is to check accuracy. Because double entry accounting requires that total debits always equal total credits, if they do not match, you know immediately that something went wrong and you go find the error. How to build a trial balance? Building a trial balance is straightforward. You go through the general ledger, list every account, write down its balance, and add up both columns. They should be equal. Here is what the unadjusted trial balance looks like for Bright Ideas Limited. Total debits, $18,000. Total credits, $18,000. They match. Our books are in balance. Why is it called a trial balance? It is called a trial balance because it is a trial run, a test. You are checking whether the books balance before you move forward. If they do not, you stop and find the error first. That said, a balanced trial balance does not guarantee there are 0 errors. It just means no mathematical mistakes were made. You could still have money posted to the wrong account, and the trial balance would still balance. Which is exactly why the next step exists. Step 5, Post-Adjusting Entries. What are adjusting entries? This is one of the most important, and most misunderstood, parts of accounting. Adjusting entries are journal entries made at the end of an accounting period to make sure all account balances accurately reflect what actually happened during that period. The reason we need them is that not every transaction lines up neatly with the accounting period. Some costs are paid in advance. Some revenue is earned before the cash arrives. Some expenses build up gradually over time. Adjusting entries fix those timing gaps. IFRS versus GAAP. Before we go further, I need to mention something that comes up constantly in accounting: IFRS versus GAAP. GAAP stands for Generally Accepted Accounting Principles. It is the accounting standard used in the United States. It is highly rules-based, very specific guidance for almost every situation you will encounter. IFRS stands for International Financial Reporting Standards. It is used in over 140 countries worldwide, including the UK, Australia, Canada, and most of Europe. It is more principles-based, giving broader guidance and leaving more room for professional judgment. For the vast majority of topics, including adjusting entries, both systems reach exactly the same conclusions. The major differences appear in specific areas like inventory valuation and lease accounting. For this video, everything I am teaching applies equally to both. What is the accrual method of accounting? Adjusting entries exist because of something called the accrual method of accounting. Under the accrual method, revenue is recorded when it is earned, not when the cash arrives. And expenses are recorded when they are incurred, not when they are paid. This is the opposite of the cash method, where you only record transactions when cash actually changes hands. Here is a quick example. You complete a consulting project in January. The client does not pay until February. Under the cash method, you record nothing in January. Under the accrual method, you record the revenue in January, because that is when you earned it. Both IFRS and GAAP require the accrual method for financial reporting. It gives a more accurate picture of a business than the cash method, even though it is more complex. There are four main types of adjusting entries you will encounter. Prepaid expenses, costs paid in advance that need to be recognized over time. Accrued expenses, costs that have been incurred but not yet paid. Unearned revenue, cash received before the service has been delivered. And accrued revenue, revenue that has been earned but not yet received. Adjusting entries example. Let me show you each type using our Bright Ideas Limited example. Do you remember transaction 3? Bright Ideas paid $1,200 upfront for 12 months of office rent. Right now, our books show that entire $1,200 sitting in an asset account called prepaid rent. But we have used up 1 month of that rent. So we need to move 1 month's worth, $100, out of the asset and into an expense. That adjusting entry moves $100 from an asset, where it was sitting as a future benefit, into an expense, because that benefit has now been used up this month. Next example. Imagine Bright Ideas completed additional consulting work worth $500 at the end of January, but the invoice has not been sent yet and the cash has not arrived. Under accrual accounting, we still need to record that revenue in January, because that is when it was earned. We create an asset called accounts receivable, representing money the client owes us, and record the revenue it belongs to. One more. We owe our accountant $300 for bookkeeping done in January, but the invoice will not be paid until February. We record the expense in January because that is when it was incurred, and we create a liability representing the amount we owe. That is accrual accounting in practice. For every period, you ask, what actually happened? Then you record it, regardless of when cash moved. Step 6. Adjusted trial balance. After all the adjusting entries are posted, we prepare a second trial balance, the adjusted trial balance. Same format as before, every account, every balance, totals must match. The difference is that this one reflects all the corrections too. Every account now shows what actually happened during the period. Debits and credits still balance at $18,800 each. Now, with the adjusted trial balance confirmed, we have everything we need to build the financial statements. This is the payoff for all that work. Step 7. Create financial statements. What are financial statements? Financial statements are the final output of the entire accounting process. They are structured documents that tell the financial story of a business in a format that anyone trained in accounting can read and understand anywhere in the world. They are used by owners to understand their business, by investors to decide whether to invest, by banks to decide whether to lend, and by tax authorities to calculate what is owed. The accuracy and consistency of these documents is non-negotiable. What are the three types of financial statements? There are three core financial statements, and each one answers a different question. The income statement answers, was the business profitable? Did it make money or lose money this period? The balance sheet answers, what does the business own and owe right now? What is its financial position at this exact moment? And the cash flow statement answers, where did the cash actually go? How much came in, and how much went out? Together, these three give a complete picture of the business. Let us look at each one. What is the balance sheet? The balance sheet, also called the statement of financial position, is a snapshot of the business at a single point in time. It lists all assets on one side, and all liabilities and equity on the other side. It is a direct representation of our accounting equation, assets equal liabilities plus equity. Always perfectly balanced. Assets of $17,400 equal liabilities of $5,300 plus equity of $12,100. Perfectly balanced, just as the accounting equation requires. What is the income statement? The income statement, also called the profit and loss statement, shows performance over a period of time. Not a snapshot, but a story from the first day of the period to the last. It starts with total revenue, subtracts all expenses, and gives you the net profit or net loss. Revenue of $3,500 minus expenses of $1,400 gives a net profit of $2,100. Bright Ideas Limited made money in its first month. Profit versus cash flow. Here is something critically important, and something that trips up business owners constantly. Profit is not the same as cash. Bright Ideas made $2,100 in profit. But look at the cash balance on the balance sheet, $15,800. Completely different number. Why? Because the owner invested $10,000 and took out a $5,000 loan. Those are not revenue. They never appear on the income statement. But they absolutely affect the cash balance. Now flip that around. A business could show a profit and still be running out of cash, because customers are slow to pay, or it spent heavily on equipment, or it is paying off a loan. This is why profitable businesses go bankrupt every year. They confuse profit with cash. The cash flow statement solves this problem. What is the cash flow statement? The cash flow statement tracks every actual movement of cash in and out of the business. It is divided into three sections. Operating activities, cash from day-to-day business. Collecting from customers, paying wages, paying suppliers. Investing activities, cash from buying or selling long-term assets like equipment or property. And financing activities, cash from raising or repaying money. Taking loans, repaying loans, owner investments, dividends paid. Net profit was $2,100. Net cash increase was $15,800. Two completely different numbers. Both valid, both important, and neither one tells the full story on its own. That is exactly why you need all three statements. Who would use financial statements? Financial statements are used by a wide range of people, all with different needs. Business owners and managers use them to understand performance and make decisions. Investors use them to evaluate whether a business is worth their money. Banks use them to decide whether to extend credit. Tax authorities use them to calculate tax owed. Suppliers use them to decide how much credit to extend. And employees use them to understand the stability of the company they work for. This is why financial statements follow such strict, standardized formats. Many different people are relying on them for many different decisions. There is no room for inconsistency. Step 8. Post-closing entries. What are closing entries? We are on the final step, closing entries. Remember when I said some accounts are permanent and some are temporary? Here is where that distinction matters. Permanent accounts, assets, liabilities, and equity, carry their balances forward into the next period. They never get reset. Temporary accounts, revenue, expenses, and dividends, only relate to one specific period. At the end of that period, they need to be zeroed out so we can start completely fresh for the next one. Closing entries are the journal entries that do that resetting. They close out all the revenue and expense accounts, calculate the net profit or loss, and transfer it into an equity account called retained earnings, which is permanent. Closing entries example. Here is how it works for Bright Ideas Limited. There are 3 steps. Step 1. Close all revenue accounts into a temporary holding account called Income Summary. Step 2. Close all expense accounts into Income Summary. Income Summary now holds the net profit of $2,100. Step 3. Transfer that into retained earnings. Done. Revenue is 0. Expenses are 0. The profit has been safely moved into retained earnings, where it will sit permanently as part of equity, until it is either distributed to the owner or reinvested in the business. Post-closing trial balance. After the closing entries are posted, we run one final trial balance, the post-closing trial balance. This confirms that all temporary accounts have been zeroed out, and only permanent accounts remain with balances. Only permanent accounts remain. Debits equal credits. The books are closed for January. Clean slate for February. The cycle starts again. The accounting cycle, summary. And there it is. The complete accounting cycle. 8 steps, 1 full loop, and then it begins again. What looks like an intimidating, complex system is actually one repeating process. Same 8 steps, every single month, every single year, for every business in the world. You now understand how accounting actually works, not just the definition, but the full process from first transaction to finished financial statements. If this video helped you, I would really appreciate a like